Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Last year was a huge year for our super funds. They were major players in some of the biggest deals across the country, particularly when infrastructure assets were involved. There were some significant legislative changes as well, and with the increase in the superannuation guarantee to 10%, there's more money than ever running into superannuation. It comes with a big responsibility for funds to make the right decisions and help members prepare for retirement. I wanted to speak to one of our big industry super funds about how they make those decisions and what this year holds for members and the sector more broadly. HESTA is the National Industry Super Fund for people working in health and community services, investing around $68 billion. Sonya Sawtell-Rickson is the Chief Investment Officer at HESTA. Sonya, welcome to Fear and Greed.
Thanks, Sean. It's lovely to be here.
We had a cracking 2021 calendar year. What do you reckon about 2022? What's the outlook for the next 12 months or so?
2021 definitely was a great year for investment markets and super fund returns. Our balanced growth option delivered 14.5% and our sustainable growth option came in at 16.7%. Look, while these are great results for our members, we don't expect the very good times to continue. I think we're seeing volatility return. We've seen that start in the very early innings of 2022 and really being driven by central banks. I think globally central banks have really turned a corner, moving away from providing significant monetary stimulus and fiscal stimulus as well from governments to really starting to reduce that stimulus and obviously for central banks starting to normalise interest rates. Now, markets are obviously forward-looking and have started to price some of those interest rate rises, but I think the speed and quantum of these changes is still very uncertain. And what we're seeing markets and the volatility we're seeing is really markets adjusting to this new information and changing expectations. So as we look forward, I think markets will still benefit from accommodative central bank and government policy, which should continue to support nominal growth and risk assets over the medium term. Although in our view, those returns are likely to be more modest than perhaps what we've experienced in the recent past.
Okay, so if I'm an investor looking at 2022, and I'm not talking about a day trader, I'm talking about an investor, what's the sort of advice? Should I be changing sectors? Should I be thinking a little differently to how I thought last year, given that interest rates are likely to rise as inflation remains relatively high?
Yeah, I think we're entering a bit of a new environment to what we've seen in the past, and I'd say the past few decades, really. We've been on a trend of interest rates falling. We're now sort of moving to a trend of interest rates starting to rise. Now, what that means is that assets that are sensitive to interest rate rises may find it more challenging. So things like bonds, for example, may fall as rates start to rise. Things that have inflation sensitivity will benefit. So, things like inflation-linked bonds or break-even inflation, things like real assets that have inflation-linked cash flows will benefit, and similarly equities that have pricing power and can pass on some of these sort of cost increases through to their product pricing. So look, I think there is an opportunity to reorientate the portfolio and benefit from this changing regime.
Okay, I'm sort of moving off the market a little bit because there are a few things I think HESTA is really interesting for. You mentioned at the beginning that your sustainability fund returned 16% and your balanced fund 14%, both great returns. Was 2021 peak ESG because of Glasgow and COP, or is sustainability here to stay, and is it as an investment strategy one that has the potential to outperform?
Look, I think sustainability is definitely here to stay. It's not just COP26. I think the reason we're getting so much momentum coming from things like climate action is because there's a lot of the community that cares about these issues. So we're seeing a lot of community interest. I think we're seeing rising community expectations. That's leading to reflecting those expectations from institutional investors and asset owners. I think we're seeing governments coming under pressure to have to take action to stay in power. And I think all of these things are really creating the momentum for ESG.
Yep.
Does it deliver strong returns? I think was the other part of your question. Look, I think I'd point to our sustainable growth option as a great example of this. I think there's been a long period where there was concern, I think, that you couldn't really deliver sustainable financial returns as well as have a positive impact on the economy, environment and society. I think our sustainable growth option we launched in 2000, so it's now got just over 20 years of investment performance. It's delivered incredibly strongly for our members. And I think as at the end of last year, it was the top performing balanced fund in the country over 5, 7, 10 and 15-year periods. So I think we've got evidence now to support our belief that having a deep commitment to responsible investment is really important to deliver long-term financial benefits for our members.
Stay with me, Sonya. We'll be back in a minute. My guest this morning is Sonya Sawtell-Rickson, Chief Investment Officer at HESTA. Big funds like HESTA are becoming more active in terms of talking to companies about their ESG credentials. I know that HESTA recently filed shareholder proposals in the US, taking on Meta, the parent company of Facebook, and Hormel Foods over ESG issues. Why is that happening, and kind of what's the strategy behind that?
Yeah. As part of our stewardship activities, we monitor company developments against our responsible investment priority areas, as well as broader ESG metrics. Here at HESTA, we've chosen 7 priority areas that are linked to the United Nations Sustainable Development Goals, and one of those is good health and well-being. So, we will file and support shareholder proposals where we feel companies are ignoring material risks to their business, where they're not taking sufficient action to address these risks. In the case of Hormel Foods, which I think is a good one, we had identified antimicrobial resistance as a growing risk to good health and well-being. The overuse of antibiotics as a growth stimulant really threatens the effective prevention and treatment of a number of infections. And we've seen the World Bank come out on this issue, suggesting that it could impact global GDP by 4% by 2050, which is obviously material. And so through our engagement partners, we'd been talking to Hormel Foods for a number of years on these issues, really trying to encourage better practice and better disclosure and improved research in these areas. We just felt that the progress from the company hasn't been sufficient. It's been too slow, and we really wanted to highlight these issues and bring some attention to these problems. And so that's a great example of where we've decided to file the shareholder resolution to try and improve the company action.
I mean, health and wellbeing is perfect for HESTA, obviously, because you represent people working in the health and community services sector. Does it weigh on you? Some of the people that you invest for, they're often quite low-paying jobs, or at least they're not high-paying jobs, shall we say that. And superannuation is so vital for retirement, particularly for people who earn lesser income and middle class. Do you ever think about that when you're making your investment decisions?
Oh, absolutely. You're right. Our members come from the caring professions. They're nurses, aged care and disability care workers, they're early childcare educators, and they're also 80% female. As you know, they're not high-paying jobs to start with often, and then women also regularly take time out of the workforce, so they have gaps in their super contributions and balanced growth. We know for our members that their superannuation is a critical pillar of their retirement strategy, and our research shows that for many of our members, it's their biggest asset. And so it contributes heavily to their ability to achieve financial security in retirement. Obviously, when we think about what drives us, our purpose, this is incredibly important. Our members are there for us when we're at our most vulnerable. They're looking after our children, they're caring for our parents, they're treating our loved ones when they're sick and unwell. And I think in the last few years, they've been on the front line of our COVID defences. And so we want to give back in the way that we can, which is really to maximise their financial outcomes. I should note, though, that it's not just the financial outcomes that matter for our members. They expect us to invest responsibly, and we've talked a little bit about how we do that, but it's very clear to us that they expect us to take their capital, generate good performance, but also be responsible in how we deploy that capital. Yep. And so we have a very heavy focus on that for that reason.
Okay, now 80% of your members are female. Now HESTA is a little bit of an anomaly in some ways. You've got a female CEO, a female chief investment officer, a female chair and deputy chair. That's unusual in the finance industry to have so many females in those sorts of roles. And how big a problem is just the underrepresentation of women in the finance workforce, and what can we do about it?
Yeah, look, it's a real privilege, actually, firstly, to work in a firm where we're representing 80% female, but then to work in a firm that has equal representation, board, at executive and within the business. As you say, it's quite unusual. It's the first place I've worked in my career where I've experienced that, and it's a real privilege. When we actually do a survey every couple of years of our investment value chain and assess, how much diversity and gender diversity and other diversity there is within that value chain. And the reason we do that is because we believe diversity improves outcomes. Obviously diversity improves debate, it improves decision making, it improves risk management. So we're quite focused on why, if this is a lever, we work in complex markets. Obviously, the more ideas and insights you can get on different lenses you can get on a problem, the better outcome. And what we found in this survey is that in 2018, across all of our managers, we only had 17% women managing our capital. We deliberately excluded all of the back office and other areas and focused on the front office decision makers. So look, quite a disappointing outcome, although it was actually above industry averages, pleasingly. So look, what we've done with our managers is really worked with them on case studies of excellence. We've looked at how do you recruit and try and remove bias from your recruitment process. How do you generate interest amongst women to come into our industry? Because it does have a little bit of a Wolf of Wall Street culture.
Yep.
And so trying to sort of explain that not the entire industry is like that there's really some fantastic opportunities for women. Trying to improve practices around work-life balance and, maternity leave and flexibility within our partners so that they can, attract women that need that flexibility. Making sure that women continue on their promotional scale when they're taking time out of the workforce to have children. And I think ultimately retaining women by creating an environment that respects them. And I think, that requires, female leadership at the top. And I think the work that we've been doing on the 30% Club to have 30% representation of women at boards, the work we're now leading, the 40-40 vision, looking to have at least 40% female representation in the executive across major corporations in Australia. I think these changes will start to create a culture where women feel heard and are okay to be a bit different.
Yeah.
So look, I think it's an exciting time.
Yeah, you can only, and hopefully the world changes, and in 10 years, it's not just women better represented, but actually all of us have got better outcomes for our retirement savings because women are better represented, which is the eventual goal. Look, a couple of things. We're running out of time, but I mean, with the superannuation guarantee going up to 10%, it will continue up to 12% over the next 3.5 years or so. That's a lot of money going into super, and particularly when you're getting the returns like you got last year. So there's lots of money slushing around the place. We've seen some really big infrastructure deals, particularly Sydney Airport being the big one, where superannuation funds got involved in purchasing an asset outright. Do you think you will see more of that sort of thing?
Yeah, look, I think as you say, we're growing. We've got capital to deploy. So we're continuing to look globally for opportunities to really generate the returns. So Sydney Airport, absolutely, and infrastructure and real assets, long-term monopolistic characteristics, inflation hedging characteristics, are natural fits for things like superannuation, where we're trying to generate real long-term returns. I think private equity, there's a lot going on and disruption at the moment and continuing, a lot of new areas that are evolving. So I think there's a lot of focus and attention going into private equity. I think property is evolving as an asset class. Obviously, we've always had office and retail and industrial. I think healthcare is becoming a more sizable area of property. So look, I think we're always on the hunt globally for areas where we think we can generate strong risk-adjusted returns, and that will continue.
Sonya, you just sounded like a chief investment officer. One final one, crypto, Bitcoin, things like that. What's your view on that as part of an investment strategy?
Look, Bitcoin is a really interesting area. It's got the potential to pose an alternative to traditional sort of sovereign fiat money.
Yep.
It's a decentralized system of finance. It allows for digitization and fractionalization of almost any asset, which really creates a huge amount of opportunity. But it's, as an institutional investor looking at it, it's also very developmental.
Yep.
We've seen volatility is incredibly high. It's multiples of equity markets. Custody, safe custody, is a real challenge. It's still very unregulated, although, obviously we're seeing these things evolving every day, but at this stage it's still highly unregulated. Liquidity, as a significant investor, requiring liquidity, being able to invest at scale is challenging. And obviously with our lens, responsible investment, there is still concerns around its use in illegal activities, as well as its high energy usage to generate the blockchain.
Yep.
So, look, I think it's an area that we continue to watch with interest.
Fair enough. Sonya, thank you for talking to Fear and Greed.
Thanks very much, Sean. It's been a pleasure.
That was Sonya Sawtell-Rickson, Chief Investment Officer at HESTA. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.